This is Robert Kraft, and I'm your host on SNN Network. And with me today for this Wall Street View is Travis Wiedower from Wiedower Capital. Travis, good to see you again, my friend.
How you doing, Bobby? Good to see you.
I'm doing well, doing well. We missed you in Vegas this year, but I'm sure we'll see you in 2020.
Hopefully, yes.
All right. So, for those who may have missed our first podcast interview, and I say first because I know there's going to be many more down the line, of course. What's your background and how'd you get started investing in microcap stocks?
Yeah, I started playing poker full time when I was younger and started investing on the side. There's a lot of overlaps between the two. That's how I got into investing. And investing started off as just a side hobby, and over the years grew into an obsession and a passion. And about 4.5 years ago, I decided to go out on my own and start my own investment firm. So I've been doing that since early 2015.
Got it. So you wrote an article about a month ago that you published on your blog, and it's titled "What Makes a Great Business." Now, I think we could probably host a course or who knows how much webinars on this topic, but hopefully we can cover this in 15 to 20 minutes. And I apologize if it goes over to everybody out there. So, for my first question on this is, what inspired you to write out your criteria for what makes a great business?
Yeah, so earlier this year, I reread Competition Demystified, which is a great investing book that I hadn't read in quite a few years. And especially the first half is just an incredible book. The second half is a little dated. But I took a ton of notes on my second reading, and I realized there's a lot of overlap between Competition Demystified and a couple other of my favorite investing books, Creative Cash Flow Reporting, Evaluation, and then not that it's a book, but Michael Mubastin has a bunch of essays that are just fantastic. And there's a lot of overlap between Competition Demystified and those sources. And I had like 50 pages of notes on my favorite investing readings, and I kind of just got motivated to try and consolidate all of that into what ended up being a couple thousand word blog post.
Well, thank you for not publishing the full 50 pages because then I think this interview for sure would be like at least 2 hours. So I wanted to dig right into the blog post itself, and one of the things that first jumped out at me when I was reading it was the growth equation that you had in there, or your equation for what equals growth. So for those who may not have read the article yet, what is your growth equation and why? And then also, what is incremental invested capital mean?
Yeah, so this is a way to kind of estimate how much a company increases its intrinsic value every year.
Mhm.
So that's kind of the growth aspect of that. And the equation is simply incremental invested capital times their investment rate. So if a company invests like 40% of its earnings and they earn 30% on that investment, that incremental invested capital, the intrinsic value of the company should increase around 12% that year.
Mhm.
Now, that doesn't necessarily mean the stock will go up 12% that year, because Wall Street might have already factored that in, or maybe Wall Street expected more than that and the stock actually goes down. But over time, the stock price and a company's intrinsic value should line up over time. And the difference between invested capital and incremental invested capital is just how much a company is investing this year.
Mhm.
So the when you're looking at a company's return on capital, those numbers can be distorted. Say a manufacturing company built a manufacturing plant 10 years ago. Well, they're still generating returns on that, but that's not capital that they're investing every year. So this is a way to try and figure out what a company is earning on the capital they're investing this year, and not the capital they invested in the past.
Mhm. So in other words, is this a similar metric that people use known as return on invested capital?
Yes, yes, absolutely.
Got it. And just quick follow up on this, because it seems that in some of my readings I've seen is that while ROIC or return on invested capital is something that's always been around, it seemed that over the last, I'd say 10, 15 years, it's taken on a life of its own amongst the value investing community. For you, why do you think that is?
Oh, well, I think ROIC is just a good kind of quick metric to see if a company is a high quality company, and to see if a company has strong competitive advantages. The only way in a capitalist society, if a company is earning high returns, generating excess profits, other companies are going to want to erode those profits away. That's just kind of the nature of capitalism, the nature of competition. So if a company is able to sustain high returns on invested capital over many years,
Mm-hmm.
that's a pretty big hint, not a guarantee, but a pretty big hint that they probably have some strong competitive advantages.
Mm-hmm.
And investors like competitive advantages. So,
Well, we're about to find out more why. But before that, one more quick question.
yep.
And you in your example, you said that the intrinsic value of that example company was 12%.
Yep.
What's kind of the normal range, or is it really have to do with the industry that the company's in when you're looking at those numbers relatively?
Yeah, it differs by industry. It differs by company. I'd say the past couple years, I've been looking at a lot more growth companies that are growing very quickly.
Mm-hmm.
So if you're growing like 50% per year, there are a lot of companies, especially like more tech companies, tech consumer companies that are investing 100% of their quote unquote earnings back into the business every year, because they generate high returns on that incremental invested capital. So it would be kind of stupid for them to not invest as much money as they can at those high returns.
Mm-hmm. Got it. All right. So diving back into the blog, the blog post itself. So your thesis for the article is that, and I quote, the best businesses can increase their value at high rates going forward. To achieve this, they must generate a high return on incremental invested capital. Thus, the most important part of determining if a company is going to have a great future is forming an opinion on their ability to continue to invest capital at high rates of return, end quote. I was just proving I can read there. Okay. But but with that in mind, what are your four categories, four moats that helps you determine how durable their competitive advantages are?
Yeah, I really categorize competitive advantages in four ways, and everyone's heard of these four. But there certainly are others. But I think the four big ones are barriers to entry, customer captivity, economies of scale, and network effects. And those are roughly in order of how important I think they are, or how durable I think they are.
Mm-hmm. All right, so let's dig into those categories a little bit right here. So the first moat, barriers to entry, and in the article is barriers to entry slash barriers to scale. Why would you say this first moat is the most durable in your opinion?
Well, it's quite simple. The less competition, the better. So if you have barriers to entry that don't even allow competitors into the industry, that's a great place to be in. As we kind of already talked about, if a company is generating high returns, high profits, that's going to attract competition, and maybe some of the other competitive advantages that we're going to talk about can prevent that competition from being successful. But even better than going up against that competition is an industry that doesn't even allow potential competitors in, and that's the case when an industry has very strong barriers to entry.
Well, what I really liked about in the article too is when you distinguish between a company in kind of a niche industry versus maybe a more mature industry, and when you see a company that's in a $1 billion industry and competition sees, okay, well, the startup costs are, I think you put in like 40 million. They're
Yeah.
saying to themselves, okay, well, that's more interesting than being in $100 million industry and it being the same capital cost to even enter it. I thought that was pretty interesting. You want to expand on that a little bit?
Yeah, so that was more under the economies of scale headline,
Oh,
but
that's right.
still certainly applies here as well. So the point I was trying to make was, with economies of scale, as an example, if an industry requires $40 million to enter the industry, like they say $40 million to build a manufacturing plant or whatever, those are the fixed costs, and the entire industry is only worth $100 million. that industry is probably going to be dominated by one company, maybe two companies. So it's just not, if one company owns that industry, it's not even feasible for someone else to enter that industry. But if that industry continues to grow to $1 billion or $10 billion, suddenly that $40 million of fixed expense, in the larger example, it's just like a rounding error. So more competitors are able to enter that industry.
I jumped ahead. I apologize, everybody.
All
Uh,
good.
so, so the second category that for moats that you mentioned already is customer captivity. What are your three reasons that customers struggle to leave a company? And by leaving a company, then I mean switching over to a competitive product. And why is this important to consider?
Yeah, I think the three main ones, and the first one's definitely the most powerful in my opinion, is switching cost. So here is it would cost the customer usually time, but sometimes it literally costs them money to switch from one company to a competitor. The example I use in the blog post is it's like a lot of business-to-business software as a service has very strong switching cost. I use an example of like a dentist office that uses some software to handle their CRM, handle the customer scheduling. Once the dentist office implements that software into their daily workflow, every employee is trained to use that software. There's some legitimate switching cost in terms of lost productivity to switch that software to a competitor. It may not literally cost them money, but it definitely costs them lost productivity and lost time.
Got it.
So that's number one, switching cost. I'd say the second most powerful is habit. Humans are a creature of habit. So customers who use a product or service on a regular basis, I think the easy example here is Coke. Well, that is a public company. I don't own Coke, but it's, I'm supposed to. But Coke is an easy example where there's nothing, if I'm a Coke drinker, there's nothing that keeps me drinking Coke. There's no switching cost for me to switch to Pepsi. I can just walk to the grocery store and buy a Pepsi. But as a Coke drinker, if I've drank a Coke every day for the past 5 years, that is a habit. I'm probably going to continue to drink that. So not quite as strong as switching costs, but again, humans are a creature of habit, and it absolutely can be hard to change those consumer habits. And then the last one is search cost. I don't quite see this as often, but this arises when it's hard to compare one company's product or service to their competitors. I think a good example here is insurance. I think banking can be another one where most consumers just don't really understand insurance. And I actually went through this recently, like a year ago. I was considering switching. I'm an entrepreneur, so I'm not just like on a business's insurance plan. So I considered switching my health insurance, and it's a nightmare. I consider myself a pretty smart person, but like trying to compare different health insurance companies is an incredibly difficult task. And I ended up not switching because I just couldn't be 100% confident that what I was switching to was better than what I had. So there's significant search costs there.
Dude, I'm just happy that my wife is a nurse. I don't even have to think about it. So the next question I have, we actually kind of already touched on it when it came to economies of scale. But
Yep.
but rather than maybe going into the example again, and I know that this answer will sound kind of like a lecture straight from my MBA class or Economics 101. But the third category that you did mention was economies of scale. For those who may not know, can you briefly define, what that means, and not only that, but what you mean here, as well as why economies of scale are also subject to the law of diminishing returns. I feel like we should have like a chalkboard or something here to draw out our graph and.
I'll try and bore you a little less than your college professor probably did.
It wasn't too bad on
Yeah,
this one,
it's
but
pretty simple. Economies of scale, first of all, they're prevalent in industries that have a lot of fixed costs. Some industries have mostly variable costs, so economies of scale just aren't much of a factor. But in industries that have fixed costs, As a company scales up, they're able to spread those fixed costs over more units, and that lowers their fixed cost on a per unit basis. So this allows the largest company in the industry to have a lower cost structure than their smaller competitors. And that's very hard. That's a great advantage because as you grow, even if your smaller competitors are growing, your fixed costs on a per unit basis are decreasing along with theirs. So that those smaller competitors just really struggle to catch up to the industry leader. However, eventually the industry will kind of inevitably reach a point of diminishing returns where the fixed costs on a per unit basis can only decrease so much. At some point, when an industry is large enough, the company is large enough, that fixed cost on a per unit basis is going to be decreasing like 1 penny at a time or 100th of a penny at a time at very mature large industries. So that's just a meaningless benefit to where, so at a point of maturity, those small companies, while they don't technically have as low as cost structure, for all intents and purposes, they do. So it's kind of economies of scale can be great when a company is growing, when an industry is growing. But once they start to mature, once that growth slows down, that economies of scale benefit generally levels off and can completely disappear in more mature industries.
Got it. So then your final category that you discuss is network effects.
Yep.
Again, for those who don't know, what is it, and why don't you rank this category higher as a competitive advantage?
Yeah, well, just to be clear, all four of these are great competitive advantages. Any competitive advantage is a good competitive advantage. But if I'm ranking, the four competitive advantages, something has to be in fourth place.
Fair
So,
enough.
so network effects are great. I own several companies that benefit from network effects. But essentially, this network effects come into play when the value of a business increases with each additional user, where one user attracts more users. It's often described as a flywheel, where users will attract more users attract more users. Kind of the classic example, again, this is a public company. I don't own it, but eBay is generally regarded as one of the first really big network effects to hit it large, where you have the buyers on eBay attract sellers on eBay, and then having more sellers attracts more buyers, and you just have this flywheel where seemingly eBay's growth just absolutely exploded over a 5 or 10 year span. And that's great. Having users attract more users is a fantastic place to be in. The problem is there's kind of two downsides to network effects. Similar to economies of scale, there is a limit to the benefit. So customer captivity and barriers to entry can at least theoretically last forever. They of course don't. But economies of scale and network effects, I think, have more clear limits to them and kind of time limits to them. So with network effects, the marginal value of an additional user just eventually is essentially nothing. Again, it's subject to the law of diminishing returns again. And then in addition to that, flywheels, while they are great when they're winding up, they can wind up very, very fast. They can unwind just as fast. Eugene Wei had a great blog post a couple of months ago called Status as a Service. If you haven't read it, I highly recommend it. But he kind of talks about this concept that network effects are great, but if you don't have something that is keeping those customers there, that is providing utility to them, that if they aren't captive customers, that those network effects can unwind just as fast as they can wind up. So they're great on the way up, but they can be awful on the way down.
That's for sure. I can only imagine. What's kind of interesting, and I literally just last night or this semester I'm taking a strategy class in my MBA. I'm finally in my last semester, but what's kind of interesting when it came to something you said earlier in terms of competitive advantages, and that they're all competitive advantages. These are all things that are interesting. If a company happens to have it. And we were doing something, one of our internal analysis tools that we were looking at. It's called VIRO, VRIO, and
Okay.
it's the idea of being able to really be able to look at a certain competitive advantage that a company might have and being able to tell whether or not it's a sustainable competitive advantage versus a temporary competitive advantage
Yep.
versus a
Yep.
competitive parity or just not an advantage would technically become a weakness.
Yeah.
So are these some similar ways in which that you can also think about, because let's say there's a company that has all four of these, but maybe it's not considered a sustainable competitive advantage versus, let's say, just a competitive parity. They just happen to be in the right place at the right time, right?
Yeah, yeah, exactly. And that's why, I think the economies of scale and economies of scale and network effects, theoretically, or not theoretically, they do have limits on them. Now, they could last for 10 or 20 years, but at some point, the benefits of those are going to run out. And over a long enough period, they can actually become disadvantages. When you look at like very large companies can enter a period of diseconomies of scale where just the bureaucracy and the size of the company, it actually starts to become less efficient.
Right. All right. Sorry. My professor's gonna be so happy when I said this. I'm gonna send this to him immediately. So, so my next question then is, to you, what would you say is the greatest moat a business can be categorized in?
Yeah, so the just on an individual moat basis, absolutely barriers to entry or barriers to scale. I kind of categorize them the same, just because if no competitors can enter the industry, or if it's very hard to enter the industry, then you're not even dealing with potential competitors. In my blog post, I kind of just coined this myself, but the greatest moat is kind of all four of them combined, because all four of these moats, barriers to entry, customer captivity, network effects, economies of scale, they all interact and they all feed off each other. So really the greatest competitive advantage is being strong in all four of these, which is incredibly rare. I mean, I could probably only name a couple companies that are really strong in all four of these categories. But if you think about it, if a company has barriers to entry, potential competitors struggle to even enter the industry. Okay, so from the very get-go, you probably don't have many competitors. If you have captive customers, your customers struggle to leave the company. If you have network effects, those customers that struggle to leave your company attract other customers that are then captive to you. And finally, all those other competitive advantages probably lead you to growing faster than your competitors. And so due to economies of scale, the bigger your company gets, the bigger your advantage gets. It's harder for smaller competitors to catch up. So when you have all four of these, it's just an incredible place to be in, and incredibly difficult for anyone to catch up to you.
Got it. So what would you say then is, and this is going also in the article as well, is what is one more important factor when analyzing a company's competitive position?
Yeah, I wanted to include one other thing that doesn't necessarily fit into any of the competitive advantages, but I think it's incredibly important, is supplier concentration and customer concentration. So a great business is in control of their own destiny, and they're the most powerful entity in their value chain. Um, but companies that have either very concentrated, very powerful suppliers or very concentrated customers, they are not the most powerful person in that value, or the most powerful entity in that value chain. So for all the reasons we just talked about of why you want a company to have captive customers, you also don't want to invest in companies that are captive to their suppliers. It's kind of the same thing. Likewise, if a company has a customer that is 25% of the revenue, or in some cases, much much higher, good luck having any pricing power over that customer. You're a public company, and that customer can easily look at your financials and see how important they are to your business. So any large customers are going to have much more power over you than you have over them. So it's hard to just be a really, truly great company if you're beholden to powerful suppliers or powerful customers.
Got it. So then my next question then is, after reading this, is why is all growth not created equally? And what are the two important factors to consider when thinking about good and bad ways to grow a business?
Yeah, so there are many different ways to grow a business, of course. And two of the most important factors are thinking about the timing of investments. So if you think of two just extreme scenarios, and then there's lots of examples in the middle. But if you internally develop a new product, those investments are made over time and they're made gradually as that product is internally developed. And if it's successful, you invest more money. If it's successful, you invest more money. But if that internal development isn't going well, then you just cancel the future investments. So the monetary risk is much lower than something like acquiring a company. When you acquire a company, that entire monetary investment is made up front. And if that acquisition turns out to be a failure, tough luck. You already paid all the money, and
Yeah.
yeah. So there's a much higher risk when the entire monetary investment is required up front.
Got it.
And then the second important factor I consider is how competitors will react. So again, same example, if a company is developing a new product internally, this is a new product category, competitors can't really react because this is a new product. They don't have a product. They can develop a competitive product themselves, but that's going to take time. So competitors aren't really going to react to that much, at least like quickly. On another one, that's a very temporary position, because if a company creates an entire new product category and it's successful, of course, new players are going to come into the space. But at least initially, it's a great position to be in. If you're in an industry or a product category that is growing very quickly, that's also a good position to be in, because they don't tend to be as competitive. If a company is doing marketing for a new industry that educates potential customers about that industry, that new product, that marketing also benefits their competitors. If they're growing the space generally, that's also helping their competitors. So the competitors, aren't going to be too upset about that. Now, if you're in a mature industry and you're taking, in a mature industry, the only way to grow the only way to grow faster than the industry is to take market share from your competitors. So if that is how you're growing, that's great, don't get me wrong, but your competitors are going to react to that. They're going to lower prices or, do more, advertising campaigns directly aimed at you or whatever it is. So there are different methods of growing, or different, more different stages of growth that companies go through where competitors react to that differently. And it's just a pretty important thing to be aware of.
Got it. Mike, one quick follow-up to all of this. How do you quantify it? How do you, when you're doing your due diligence on a microcap company, or I know you look at everything, but let's say, just for the sake of the being in microcaps like that we are, how do you quantify all of this stuff that we kind of went over today? I mean, it seems like you could get yourself so far down a rabbit hole that you're just like, oh my gosh. Is this still a competitive advantage? I'm not sure. You know what I mean?
Well, I think that's a great question. I think it kind of gets at the fact that I think qualitative aspects are just as important, if not more important, than the things you can quantify. Because, like you said, a lot of these things you can't really quantify. Some of them you can. So, like barriers to entry, for example, an industry that has 50 competitors in it, there's probably pretty light barriers to entry or zero barriers to entry. If an industry is an oligopoly with 3 players who have dominated for the past 20 years, there's probably pretty strong barriers to entry into that. On customer captivity, you can look at like churn, and if a company keeps 95% of their customers on a year-to-year basis, there's a pretty good chance those customers are sticking around because they kind of have to, and it's hard to leave. Some of the competitive advantages can kind of be quantified, but you're absolutely right that most of these are kind of qualitative things that you really can't quantify, and you kind of just have to get a sense for them, I guess.
For sure. So, so then, this is one of my last questions here well, I got a couple more, don't worry. For those who this is at the 30-minute mark. Uh, how difficult is it for a great business to stay great?
Difficult, but maybe less. Of course, it's very difficult, but
Difficult.
maybe less so than, and I think this was my point in the blog post, less so than a lot of investors might think. That's what the evidence points to. So, mean reversion is a very popular concept in investing. I think it's kind of the basis for a lot of what you would call traditional value investing, where you're buying, like net companies that are pretty crappy companies, but you think they're going to mean revert and be slightly less crappy in the future, and which is has proven to be a perfectly viable investing strategy. And on the flip side of that, I think most investors assume, and in most cases it is true, that great companies will mean revert and become less great over time. But the evidence actually shows that the top, I forget what the exact percent is, but like the top 10% or top 20% ROIC companies, so companies that are earning the highest returns on capital, actually do not mean revert nearly as much as you would expect looking at kind of the other 80% of companies. So there actually is some evidence that the best companies out there that probably are benefiting from most of these competitive advantages actually continue to benefit from these competitive advantages for longer than the market often thinks they're going to.
Got it. So my final question, to
Yeah.
summarize, what would you say the difference between a good and a great business are?
Yeah, I would say a great business is one that has very strong competitive advantages, can generate high returns on invested capital for many years into the future. And I would say a good company is still going to be an above average company. They still probably have several competitive advantages, but maybe they only have two of the four, or three of the four, or maybe they have all four, but they're just not super strong. Maybe they have there's moderate barriers to entry, or there aren't really strong barriers to entry, or they have customers that are that use their product a lot due to habit, but there's not necessarily switching costs. So they have, I'd call them moderately captive customers, but there's nothing like forcing them to stick with the company. So I think it's the same framework to judge companies off of, but they're just gonna not score quite as well on all of those competitive advantage metrics.
Got it. And I would assume, in small micro-cap, nano-caps, there's going to be some hair, or in this case, maybe have 3 out of 4, 2 out of 4, or maybe in the other two or one, it's like a little bit kind of there,
Exactly.
right?
Yes, there's a lot of that.
It's all about discipline.
Yes.
All right. So I'm going to let you go here, but real quick, where can my audience find more information about you and Wiedower Capital?
Yeah, I always point people just to my blog, traviswiedower.com. From there, you can find my website or my Twitter, or anything else. But the blog's kind of the central location I point people to. And I was actually thinking today before this interview, I'm pretty sure you are the reason I originally joined Twitter.
That is correct.
Yeah,
You're
around.
welcome, and everybody.
And now so yeah, because of you, I joined 2 years ago, and now I actually use it a decent amount. It's a pretty valuable way to interact with investors, and it can be a good kind of crowdsourced idea generation. And yeah, so thank you for that.
You're very welcome, and you're welcome, world. But, that's so lame. Okay, I take that back. But anyways, real quick, also, I know you did disclose, but just in case, at the very end here, I think you mentioned a couple companies. Do you own any shares? I believe it was in Coke or eBay.
No, I do not own either of them.
Beautiful. All right, Travis, thank you again for joining me today, and I'm sure we'll be talking again soon.
Thank you very much. It was fun.
All right, man. Have a good one.